Welcome. Today we look at something a lot of investors gloss over until tax season hits. Two people each book a $5,000 stock profit. One may owe about $1,000 in tax. The other can keep nearly all of it. What's the difference? Where and how they invest, taxable brokerage versus a Roth, IRA, or 401k. Tax rules like bank savings rates depend on the account type. U.S. tax rules shift over time, and Fed-era rates change the backdrop for returns. Used well, tax-advantaged accounts can cut a meaningful slice of the bill. Always recheck the latest IRS guidance. Start with the biggest mindset shift. In a taxable brokerage, U.S. stock profits are usually capital gains, but inside a Roth IRA, qualified withdrawals of growth can be federal tax-free. Plain English, the same $10,000 gain that might cost about $1,500 at a common 15% long-term rate in a taxable account can leave zero federal tax on that growth in a Roth if you meet the rules. That is the whole point of the bucket. On a daily chart like the one on screen, a big NASDAQ name, buy and sell profit in a taxable account still shows up at tax time. Open your broker app's tax center and you will see 1099, B sales and cost basis. You will not magically see tax equals zero just because commissions were free. One caveat: dividends paid into a taxable account are still taxed in the year you receive them. We will dig into that dividend slice next. Unlike some countries that skim a fixed percent on every sale, U.S. equity trades do not carry a Korean-style 0.20% to securities transaction tax. Selling is not free, though. Sell $10,000 of SPY, thus and pay $500 on your screen, and tiny SEC Section 31 and FINRA activity fees come out in pennies to dollars. The real bill is capital gains tax when you realize a profit. Even a losing sale can still leave those micro fees. Think of them like a bus fare. Small each trip, annoying if you ride all day. Short-term flips also push gains into ordinary income rates. That is one reason constant in-and-out trading often underperforms patient holding. Historically, long holding periods tend to keep more of what the market actually pays you, especially when the Fed cycle is noisy. If you buy dividend payers, pay attention. Qualified dividends from many U.S. companies are often taxed at the same preferential federal rates as long-term capital gains, commonly 0%, 15%, or 20% by income. On a quality dividend name like the one on this daily chart, $1,000 of qualified dividends at 15% means about $150 to the IRS and $850 in your pocket. It feels like a $1,000 rent check, where $150 leaves before you can spend it. Under typical mid-2020s U.S. rules, qualified dividends get that preferential treatment. Ordinary, non-qualified dividends can be taxed like wages. Foreign dividends may face foreign withholding first, then a possible foreign tax credit on your U.S. return. A fat headline yield looks smaller after tax. That is why parking dividend growers inside a Roth or other tax-advantaged account can matter as much as picking the ticker. Now, the strategy. For most U.S. investors, the two workhorses are a Roth IRA, tax-free growth later, and a traditional IRA or workplace 401k, tax break now, tax later. A Roth is like paying tax on the seed, then letting the tree grow federal tax-free if withdrawals are qualified. Contribution limits change yearly, recently on the order of $7,000 for many adults under 50, with catch-up room if you are older. A traditional IRA or 401k works differently. Eligible contributions can cut this year's taxable income. Money that would have gone to the IRS comes back as a lower bill, and you settle tax when you withdraw in retirement, often after 59 and a half. You can review last year's Form 5498/W, 2 Box 12 and your broker's IRA summary yourself. Fill 401k room, at least to any employer match, then IRA or Roth space, and only then a taxable brokerage. That order usually shrinks the tax drag on S&P 500 and NASDAQ returns over decades. How do you actually do it? Sequence matters. First, put $7,000 into a deductible traditional IRA if you are eligible. In a 22% federal bracket, that is roughly $1,500 of tax savings this year, not a refund check mailed for fun, but a smaller amount you owe when you file. Second, add $3,000 more to a deductible IRA or push extra into a 401k. At 22%, that is about $660 more. Combined, you are in the ballpark of $2,000 of federal tax savings. Exact dollars depend on income, filing status, and deduction phase-outs. Third, use Roth rooms so future growth, including dividends, can come out federal tax-free when qualified. Fill all 3 layers, and the annual tax drag shrinks hard. Most brokers offer a simple retirement contribution or tax estimator so you can preview your own numbers before year-end. Wrap up. For U.S. stock investors, the edge is not a secret ticker. It is putting the right dollars in Roth, IRA, and 401k space before a plain taxable brokerage. In taxable accounts, long-term gains and many qualified dividends often face preferential rates, commonly 0/15/20% federal, while short-term trading is taxed like wages. Tiny SEC/FINRA sell fees still nick every exit. Used to the rules, Roth growth, deductible IRA/401k contributions, and taxable brokerage leftovers can save hundreds to a few $1,000s a year depending on income and contribution room. Confirm details with the IRS and your broker. Thank you. This lesson is for education only, not investment advice. Every investment is your own responsibility. Tax rules change, so before you trade or file, recheck the latest IRS publications and your broker's official tax materials.